Welcome to FNArena Talks. I'm Danielle Ecuyer, and I'm very excited to be here in London with Michael Howell, founder and CEO of Cross-Border Capital, and also author of Capital Wars at Substack.com. Michael, thank you so much for joining us today, or should I say, me joining you.
Okay, well, great. It's great to be here, Daniel. Very good to see you again.
Yeah,
looking forward to it.
Absolutely. So we're living in really interesting times at the moment, Michael. I did like your comment earlier that, markets are always interesting, but they seem to be ever more interesting at this point in time. From your perspective, can you just outline how cross-border capital just briefly analyzes liquidity? Because a lot of our viewers haven't seen your work for about a year. So just a reminder how you look at global liquidity, because liquidity seems to be a term that's tossed around quite frequently these days.
Yeah, I think it's worth drilling into what it means and why it's important. The fact is that markets are moved by money. So what we've got to try and understand is that flow of money. And what we do is we track money flows through world financial markets, which is what we call global liquidity. Now, liquidity, as we said, moves markets. And the big change that probably we've all witnessed in the last, 30, maybe even 40 years, is that money flows in markets have really come to dominate price movements. So understanding investment now is not really so much about going down to the micro or drilling into what is the value in a particular stock or security. It's much more about understanding these money flows and what big investors are likely to be doing. So that list would include hedge funds, it would include sovereign wealth funds, it would include central banks. And what we need to do is to monitor their participations or transactions in markets. And that's what we pretty much do at Cross-Border. We track these movements around the world.
And I guess the thing that's worth just highlighting, you're not just talking about changes in interest rate policies between central banks, are you? This is much deeper about, printing money. And as you said, a lot more factors that go into it than just, tracking M1, M2, etc.
Yeah, exactly. The key thing is to ask is what do interest rates really mean now?
Yeah.
And that's a puzzle. And I scratch my head and don't really come up with a sensible answer. If you go back to what the textbooks would tell you, they would say that you've got a regime where households are in surplus. They've got surplus savings. The corporate sector has got capital spending to undertake. It's in deficit. It borrows from households, and essentially interest rates are the arbiter between the two. Well, that makes perfect sense. Trouble is, we don't live in that world anymore. We live in a world where the entire private sector is in surplus. Corporations are sitting on big cash piles. They are going to invest whatever, regardless of interest rates. And actually, the big deficit sector in the economy is the government sector.
Yeah.
So the government is basically transferring interest payments to the private sector because it's in debt. And therefore, if interest rates go up, actually, in theory, private sector incomes go up. So you can actually argue the complete reverse of what the textbooks tell you, that actually higher interest rates are a source of stimulus, not a source of contraction. And that's really the puzzle that we've got. The whole world has turned topsy-turvy. The other thing to think about is that capital markets today are not about raising capital for new investment projects. The only large-scale investment that's been going on, frankly, is in China. And interest rates are not really the thing that determines the investment cycle in China. So what are financial markets doing in the West? They're principally refinancing the huge debts we've got. And those debts basically need liquidity or balance sheet capacity to be rolled over. And that's why monitoring liquidity is really the crucial element in markets.
Can you wrap some numbers around the extent of that debt that needs to be refinanced and how soon it needs to be refinanced?
Yeah, the answer is that you've got worldwide about $350 trillion of debt.
That's mind-blowing, isn't it?
Yeah, it's a huge amount. And you think the world GDP is about 120 trillion. So you're talking about pretty much 3 times, which is an eye-wateringly large amount of debt to refinance. The pool of global liquidity is touching 200 trillion, so it's big. And broadly speaking, what we need is a ratio of about 2 times for financial stability. In other words, you need 2 times debt per unit of liquidity to actually mean that the debt gets refinanced. Now, if you've got a $350 trillion stock of debt and you assume that the average maturity of that debt is about 7 years, you're talking about $50 trillion a year of refinancings alone. This is on top, this is obviously a gross amount, but it's on top of what net debt is being taken up as well. So you're looking at a debt pile that is just basically turning over enormously every year, and capital markets are basically swallowing that. And they need liquidity to operate. If you don't get the liquidity, in other words, if the debt liquidity ratio skews away from its normal levels of 2 times, you see financial crises when it's too high, and you see asset bubbles when it gets too low.
Before we get to where we are in the cycle, because we've got your presentation, which we'll definitely go through, can we just touch on the fact that we're going to have a potential change in the head of the Federal Reserve, Kevin Warsh, that assuming he comes in, and he's been quite vocal, as has Treasury Secretary Bessent, about shrinking the US government balance sheet. And I think it's a really interesting topic because there's a lot of critics about how much money has been printed by governments post GFC, particularly. And more recently, it's the critics over what happened in COVID. But I guess the point is now, has the system, as you've just highlighted, become so large, there's so much debt, so that if they try and shrink the balance sheets, that we start to unravel, and it's actually something that they won't be able to achieve. So it's more ideological rather than a practical thing that they'll be able to achieve.
Correct. It's pure nostalgia. And the fact is that a lot of these policymakers grow up with small central bank balance sheets. I think you can understand the sentiments of the US administration saying that maybe the footprint of the Federal Reserve or the remit of the Federal Reserve seems to have grown enormously, inordinately maybe, because they tend to be going down many different rabbit holes rather than doing what they should be doing. And I kind of sympathize with that. But the fact is that you need a big financial sector balance sheet in order to roll this debt over. And what governs, or who governs, the size of the financial sector balance sheet? It's the central bank, or in this particular case, the Federal Reserve. Now, if you start to look at the math behind this, what you've got is federal debt, and let's take it as accepted that the main role of the central bank is not about inflation fighting or about employment. It's all about maintaining the integrity of government debt. They need that sovereign debt market to function. And believe me, if there are any problems, central banks will come in with alacrity. Now, that is a big ask, because the size of the federal debt pool has grown 5 times since the GFC. So this is a big change, 5 times bigger, and the dealer capacity of the market has actually probably halved. So in other words, banks have actually reduced the size of their dealing operations, which means that the Federal Reserve is already on the hook time and time again whenever you get dislocations in the markets. Now, the problem as well that we've had on top of that since the since the GFC crisis, is that collateral has become really the centerpiece of lending markets. So something like 80% or close to 80% of all lending in the world economy now demands some form of collateral. That collateral is typically a US Treasury bond. That's the main form of collateral that financial markets tend to operate with. So in other words, to borrow from a dealer bank, you need to post Treasury collateral, and they will give a haircut to that, and you can borrow. So the haircut may be, let's say, for example, you post $1,000 of debt, you may get a haircut of 10%, which means you can borrow 900 from the bank. Now that haircut will vary according to market conditions, but the whole process of using collateral means that the system is increasingly pro-cyclical. So what you've got is, first of all, a bigger cycle, and secondly, you've got smaller capacity among dealer banks, and therefore the Federal Reserve is really on the hook more and more. And that's why you've got to have an active and big active Fed and a large balance sheet to operate with. So the whole idea of shrinking the balance sheet is nostalgia. Now, there is some talk or debate about whether the Federal Reserve can actually shrink its balance sheet, because bank regulations are changed dramatically, which means that banks basically don't have to hold such bigger cushions against volatility. Well, they can do that, but it would sound to me a pretty imprudent thing to do. So you're actually inducing more leverage into the system for the sake of actually getting a smaller Fed balance sheet. That doesn't seem to be sensible policy making as far as I can see.
And the implications by inference that the collateral is US Treasuries, does that somewhat then, I suppose, push aside or negate the argument that the US dollar is in terminal decline in terms of being, the major currency, because the collateral by definition is US dollar denominated debt?
Well, yes, I mean it's one of the factors that really supports the dollar. That's for sure. But I think generally you've got a sort of network effect globally, which is really supporting the dollar. And one of those pillars, if you like, to mix my metaphors, is the treasury market. So absolutely, I mean the fact is that everyone uses treasury collateral. The dollar is integral, and there's really no alternative. No other country has deep financial markets, or as deep as the US. China, which people often cite as the potential rival of the dollar, has capital controls. There's no international footprint for the Chinese bond market. It's big, but it's domestic.
Absolutely. So at this point in time in the cycle, and just to let everybody know, Michael, you often do a lot of interviews on YouTube, which I highly recommend. But you also have your Substack, don't you? Capital Wars at Substack. For those that want to subscribe, we subscribe. Love reading Michael's work. And you've been very much on the front foot, that you've been telling all your listeners, readers, that the cycle is starting to turn at this point. And recently this week you described it, amidst all the volatility and all the uncertainty that we're facing with what's going on in the Middle East, that the elephant in the room is the liquidity cycle looks like it's going to continue, or it's contracting.
Yeah, I mean the fact is that before the Iranian crisis, liquidity was beginning to go down. I mean that's absolutely for sure. The cycle peaked around Q3 of 2025. So we probably had, 3 to 4 months of absolute drops in the liquidity cycle. And I should stress that liquidity cycle represents, or is defined as, a rate of growth. And the reason for looking at a rate of growth is that financial markets typically price at the margin. So if you see slowing growth of liquidity, that tends to be crucial in terms of driving asset prices. And what we've already seen is markets laboring, in the run-up to the Iranian tensions. They've clearly dropped through the crisis. But the fact is that this is an ongoing process. And liquidity, as far as I can see, is not going to come back quickly for a number of reasons. I mean, one is that central banks don't seem to be too inclined to ease right now. The bond markets, I think, quite correctly are beginning to sense that central banks may be tightening. The Reserve Bank of Australia has already raised interest rates. The BOJ is wanting to push rates up more. The ECB is talking about higher rates, and bond market investors are beginning to discount higher terminal policy rates across the term structure. So I think the fact is that we're in a period where it's very unlikely that central banks will be able to ease, despite that being very high on the wish list of the US administration. I just don't see how it's possible. The other thing that's biting into liquidity is the fact that we've got two other calls on liquidity. One of those is higher oil prices, and the question is, how high can oil prices go? And we put a piece out on our Substack maybe a week or so ago that just said, look, if you look at the maths of this, it looks quite scary, given the fact that, let's take for convenience a gold price of about $5,000 an ounce, okay, as a starting point. I mean, I know it's lower than that now, but let's assume that's an equilibrium or a fair value. Over the long run, the gold oil ratio has basically averaged about 20 times. In other words, it takes 1 ounce of gold will buy you 20 barrels of oil. So if you look at that ratio, that's been true through time. If you go right back to 1970, oil prices were then about $2, and the gold price was $35 an ounce, so about 20. And you just go through time, you'll see how that works out. Now, the fact of the matter is that if you take $5,000 an ounce of gold, and that 20 times ratio is intact, which, as I say, it has been over that long duration, you're talking about $250
I
a
know.
barrel.
I read that piece and I just felt myself gulp.
Yeah. Now,
it's huge if the ratio holds.
Yeah, I mean, somebody said to me, we presented to a client about 10 days ago this idea, and they said, well, you're just insane. That's never going to happen. And my point is, well, look, it's simple maths, and you just got to, you just triangulate that. Either the gold price is wrong, like here, the gold price is coming down, but how far is it going to come down? The gold oil ratio assumption is wrong, but why should it be different this time? Or the oil price projection is wrong.
Yeah.
So one of those three just doesn't line up, and that's really the question to deal with. Now, my view is that gold is pretty much underpinned by the monetary inflation that is being enacted generally by policymakers because they have to finance this huge debt, and they're going to need liquidity to be pumped into markets to do that. So the gold price is a very good barometer of that, and that extends not just across the West, it also applies to China. Actually, it probably applies more to China than anywhere else. They need to print money, and they are printing money, and the gold price is elevated, and the Chinese are buying gold. We know that. The other question is that on top of a high gold price, what you've got is commodity prices generally lifting up. So this is not just a gold and oil phenomenon. All these things are moving. So I think we're in a period where commodity markets are going to get a significant uplift over the next few years. And this looks to me remarkably like the 1970s, although I hesitate to say I barely remember it, but I mean, there we are.
You're not Robinson Crusoe there. So.
But anyway, the fact is that you've got a situation where inflation, commodity inflation at least, is going to be pronounced over the next few years.
It's interesting because there's a saying, isn't there? Higher prices basically, at some point kill off inflation.
The cure for higher prices
is higher prices. Exactly. That's the expression. And on one of those pieces I was reading, you were discussing term premia on the bonds in terms of the fact that the bond market is already, you were suggesting, starting to say that, the higher prices, the higher oil price, along with potential rate hikes in the markets, is going to, inevitably slow economies. The term premia might be starting to suggest that. Can you expand on what you were talking about in that piece?
Yeah, it's going to be. I'm going to be caught in the weeds a bit because it's a sort of wonkish idea, or a wonkish concept talking about bonds, and people's eyes normally glaze over when bonds come up in discussions. The fact is that bonds have there's a lot of information in the bond markets, and we ought to pay attention to it. And if you think of a bond yield, it basically consists of two components. One is an expectation for interest rates, in other words, by policymakers, in other words, what the Reserve Bank of Australia or what the Bank of England or what the Federal Reserve is going to do with policy rates. And the other element is a risk premium, which is called a term premium, which basically is the risk premium that compensates you for holding interest rate risk over the term of the bond, and it's called a term premium. Now, typically, you've got those two moving parts, and it's important to differentiate the two. If you look at what's going on in bond markets right now, what you find is that interest rate expectations are rising significantly across all global bond markets, and term premia are dropping in all global bond markets, apart from the Asian bond markets. And there may be something different going on there, but Japanese term premiums still seem to be rising, and Chinese term premiums still seem to be rising. But in the West and Australia, what you're looking at is term premium basically dropping. Now, what that's indicating is that investors require a smaller risk premium to hold bonds. So it's telling you that there's an increasing appetite for government debt. And that is basically a shift towards safe haven investments. So what the bond market is telling you, read through the nonsense that a lot of journalists are putting out, which is saying that, there's a big bond sell-off and this is the end of the world. The fact of the matter is that what the bond market is telling us is that effectively there is declining risk appetite among investors.
Does that signal in any way something potentially, I don't want to say GFC-like, but there's a lot of, again, the media concentrating on what's going on in the likes of the private credit markets and concerns that there's illiquidity there, et cetera, et cetera. Are there potential strains and stresses in the financial system that potentially can go to, let's say, a more sharper liquidity drawdown?
Yes, there's absolutely no question. The other thing that we've got to think about on the horizon is the debt maturity wall. The debt maturity wall is basically a situation or a concept that describes the amount of debt that is coming back into the system that needs to be refinanced. And if you go back to the COVID crisis in 2020, what happened then was that interest rates were slashed to near zero as a way of digging ourselves out of that emergency. The problem is that interest rates incentivize people to take on more debt. They also encourage what's called a terming out of debt. So if I've got a borrowing that is likely to come due in the next year or so, and I'm paying 5% interest or a 5% coupon on that, if I can refinance for zero or near zero, I'm going to do that. And so what happened in the COVID emergency was that a lot of borrowers termed out their existing borrowings to later on this decade. So you've got this huge bunching of debt that's going to come back. And that's what's called the debt maturity wall that we're facing. So financial markets have got to scramble up that wall somehow in the next 2 or 3 years against the backdrop of increasing tensions in geopolitics and a backdrop where inflation may be rising and where central banks may be deciding they're going to put their foot on the brake. So, there's an old saying in Ireland that, to the lost traveller, if you want to travel to Dublin or get to Dublin, don't start from here. And that's really the point for central banks or policymakers. This is a crazy place to start from, but this is where they're starting from. And they've got to try and negotiate higher inflation risks, which means they've got to tighten monetary policy. At the same time, is that the financial system is got this this rapacious need for liquidity to refinance debts, and one of those is not going to work.
The other point that I really like that you were bringing out in some of your interviews was the fact that there's so much investment going on in regard to the likes of infrastructure in the US and around the globe. And this is all to facilitate the AI investment. And you've seen a lot of the big tech companies that were sitting on huge wodge loads of cash flow. They're now coming to the debt markets as well because they're spending, billions and billions. And you have a great expression there about capital being somewhere, and it can't be everywhere. It has to go somewhere.
Yeah. I mean, what we say is that all money that's anywhere must be somewhere, and if it's going into the real economy, it's coming out of financial markets, so it can't be in two places at once. So the fact is that what you've got is this huge AI spend. Now, if you sort of go back a year or so, a lot of these big tech companies were sitting on huge treasury balances, in other words, big cash piles, and those cash piles have actually been drawn down significantly. So a lot of these AI or tech companies are actually moving into a regime where they're going to be net cash flow negative, which is a whopping great change to where they were, 12, 18 months ago. And that means that they're going to be demanding more funding from markets. So if you look at the new funding demands on top of the existing funding demands for rollover, you're looking at a lot of strain coming through financial markets. Now, I touched on the fact that higher commodity prices and particularly higher oil prices are going to drain liquidity as well. But the fact is that the energy sector, and particularly the oil markets, use a lot of liquidity. I mean, just think of the amount of working capital tied up in things like freighting oil in tankers. I mean, this is big money. And you've got to spend on top of that for new infrastructure for energy that's been destroyed. You've got to pay for this Iranian war that Trump has triggered. This is more and more demands on capital markets. So the amount that's left over for asset prices to go up is being shaved all the time.
It's quite hard to, find a rosy outlook. What am I missing?
Well, I think the thing is,
where do you find the safe havens against this backdrop at the moment? Given that the backdrop can flip at any point a little bit in terms of, the war may be over, but as you said, the investment spending still has to come in, particularly since there's been so much destruction.
Well, I think the thing is that what this tells us is that there are two dimensions to markets. One is a cycle, and that cycle can be vicious, and we've seen that many times in recent years. That what goes up always comes down. But there's also a trend, and that trend is dominated by liquidity and by what we call monetary inflation. And the only way out for governments right across the West, or in fact the West and including China as well, one has to do now, is that aging populations and the sort of commitments that have been made to welfare states means that governments are basically bankrupt around the world. Now, of course, a government never goes bankrupt because it can always tax us, it can always fund in some way. What we're really talking about is, how high do taxes go, and what do interest rates have to jump to? And that's really the question. So the route they're going to take is probably printing money in the old-fashioned way, and that's kind of happening already before our eyes, because what you're seeing is more and more evidence, and it's certainly true in the US, but it's true here in Britain. It's increasingly true in Japan, is that governments are going to the short end of the market to actually issue their debt. In other words, they're not issuing 10-year debt, they're issuing bills of 3 months or 6 months. Now, in terms of public finance, this is madness, but it's going on. And the reason it's madness is that they're really vulnerable to changes in interest rates. So if interest rates suddenly jump, their interest bill starts to jump as well. And the whole debt problem then becomes exponential. And you get this skyrocketing amount of debt. So it's not a great policy, but it's happening. Now, the reason that I say that this is monetary inflation, and we've got to be careful about that, is one of the key questions to ask is, who's buying that debt?
Yes, right.
And the answer is that it's typically banks. Now, if banks buy government debt, or banks buy any debt, it's called monetization. Okay. In other words, it's printing money. And this is what's happening before our eyes. So the whole idea of going to the short end of the market to fund is a reaction to the fact that it's easy to do, but it's easy to do because the banks have got this big appetite to buy government debt, because it matches their liabilities almost perfectly. So they're big buyers. So the governments are now effectively printing money, and this is creating monetary inflation. And we know that never ends well. How do you avoid that? So what you've got to look through the cycle, and you've got to, don't try and trade monetary inflation hedges, own them. And that's really the key thing to do. So don't trade gold, own it. Don't trade high quality equities that have got pricing power, own them, because they're going to come through this pretty well. Okay. But what you've got to do is to avoid some of the more speculative assets that have been pushed up in the so-called everything bubble in the last few years.
From a short-term perspective, you mentioned gold there, and possibly crypto might go into it. In the short term, though, if you do get that spike in the oil price, and your relationship between oil and gold works, so any retracement in this gold price, there's forced liquidations in some instances. I mean, I've heard that apparently the Saudis have been selling some of their gold holdings to fund something. Now, whether that's the case or not, we don't know. But does that mean potentially there's opportunities that are going to emerge in this period where you see some of these asset prices retreat?
Yes, I mean, I think unquestionably. I mean, as I said, I mean, you've got to own gold. Don't worry about trading it. But if you want to accumulate gold, do so on weakness. And I think the rule that I've said, and this applies to Bitcoin as well, is you've got to look at the trend in these assets. Bitcoin is probably a fairly decent monetary inflation hedge. It's certainly proven that in the last 15 years. Gold has proved that over 5,000 years. So it's got a much better track record. But the fact is that you've got to buy these monetary inflation hedges when they're below trend. So look at what the trend is. Just put a 200-day moving average through a chart, and buy it, when it's at least one standard deviation, circa 20% or so below that trend. And that's a fairly decent long-term investment strategy. That's what I would be doing.
Absolutely. So in terms of the cycle, typically how long does it take to play out between peak and trough in terms of the historical analysis that you've done?
Well, the cycle, the liquidity cycle per se, is roughly about 5 to 6 years long.
Refinancing cycle. Almost.
Yeah, that's a debt refinancing cycle, but that's really what's controlling liquidity. And that cycle bottomed last time in October 2022. It peaked in, let's say, September, October of 2025. It's likely to be falling through 2026 and may make a turn in 2027. So you've got some sort of perspective as to how long this may last. And I think it's going to last well into next year. So even, regardless of looking through the Iranian conflict, we're already in a downswing for liquidity, and one has to be more defensive and much more selective in investments. And that's why you need an active asset allocation. But you do, on top of an active asset allocation, need a core. You need to separate your portfolios into core holdings and into, if you like, a tactical overlay, which corresponds to the cycle.
How important is cash at the moment going
Very.
to this point?
I mean, very important. I mean, that's been one of our recommendations for the last few months anyway, to build up cash holdings. But I mean, to run through what we've been arguing, I mean, we've been basically saying that you want to be reducing exposure in equities. We think that the US market is in what we think of as a speculative phase, and therefore you've got to be paring down US equities. Generally, non-US equities are probably a tad behind the US, but they're more or less there. So, I'd extend that to a general reduce equity exposure. We've been shifting money into short duration bonds. So in other words, that means cash and probably things up to about 5 years in terms of the bond markets. Gold and resources, or gold and commodities, I still like as an investment. Buy them on weakness. I mean, there clearly will be weakness during this shakeout, but again, I think that's worth doing. And the reason that gold, particularly gold, looks good is that we're moving into an era where you've got, first of all, monetization by central banks, as we've alluded to, and gold is a great hedge against that. But in particular, China is undergoing a very significant monetization. Now, forget all this stuff about that you hear in the media and among economists that China has to revalue upwards its exchange rate. It doesn't. It has to devalue its exchange rate enormously. If you look at an economy like China, which is facing debt deflation internally, in other words, what you're seeing is the economy is struggling under a weight of debt. Prices are actually falling on Main Street in China. And you've had, until recently, that is, relatively weak asset prices. Generally, what that requires is a lower real exchange rate, which means that basically the Chinese have to devalue, and they do that by printing money. And that's exactly what they're doing. They're trying to devalue the yuan internally by printing money aggressively, and they're trying to maintain the value of the yuan internationally. So an interesting deviation there. Trying to preserve it internationally by buying gold themselves. So they're, if you like, backing the yuan in the international arena with gold, and that will enable them to have, if you like, a differentiated currency regime from the US. So the US is moving to a world where you've heard of stablecoin. Stablecoin would be a very important backing for the US dollar. That's effectively wrapping treasuries in a sort of digital security, but that's backing the dollar, and the Chinese system will be increasingly backed by gold. So you've got a long-term bidder for gold there, on top of the fact that domestic inflation in China is causing Chinese investors to basically pile into the gold market. And who controls the price of gold now? It's not COMEX and it's not the London Exchange, it's the Shanghai Gold Exchange. That's where the pricing is.
Yeah, really interesting. Can you touch on stable coins? Because that's something that I feel probably Australia, it's, we're just starting to get our heads vaguely around it. So can you, touch on that for us?
Well, okay. I mean, stablecoin basically, as opposed to volatile coin is Bitcoin, okay,
right,
or Ethereum, all these things that swing all over the place. So it's a digital currency. But stablecoin is supposed to be, it's engineered to be more robust and stable, and basically matches the dollar. So basically, if you put your money into a stablecoin, that money will be invested in very short-term treasury bills and US Treasury securities, like short-dated notes, probably up to 2 years or whatever, and therefore it will be able to maintain its value. It's a little bit like a money market fund. I mean, there are clearly a number of questions about the integrity of those things, but there's a piece of legislation going through at the moment in the US called the Clarity Act, which is trying to actually make this whole process more transparent and actually nail down the use of stablecoin. Now, this is a huge, huge advantage potentially for America. There is no question about that. Because if you start to look at currency regimes around the world and flaky currency regimes around the world, like Latin America or Africa or whatever, don't a lot of these residents prefer to put their money into a digital US dollar stable coin than trust it with a local central bank? And the answer to that is absolutely yes. And that is what's going on. So you're starting to see a big take up of existing US stablecoin by residents of these countries. Now, this is basically underpinning not a de-dollarization, but a re-dollarization of the world.
Monetization of their debt as well.
Yeah. So the whole point is that what you're getting is the dollar is becoming a more important currency in these countries than not. Now, then there are some questions here. What about China? Well, China is hugely scared by this for the simple reason that if you're a Chinese exporter and you've got this huge dollar balance you've built up, you risk it being sanctioned by the US, and therefore you think, well, okay, maybe what I ought to do is to think of an alternative than holding it in a US bank. Could you put it into a Chinese bank? Well, sure, okay, but then you risk being sanctioned or whatever, your assets sequestrated by Xi Jinping if he feels you're not doing the right thing. So there's a risk there. So why not put it into stablecoin? Because there's an obvious, you've got some anonymity and a lot more security than in a traditional bank account. The problem is the Chinese just banned that. About a month ago, they issued a notice called Notice 42, which doubled down on their existing bans on crypto and digital assets. And they said absolutely verboten, they built a great wall, if you like, against that, against any digitalization, because they saw the threat immediately. What about Europe? Well, they're slow to wake up. And they're now saying, well, okay, this stablecoin is a threat to the European monetary system, because basically you get more residents starting to hold dollars because they can be outside the European tax net in theory, and there's some degree of anonymity. Think about Britain, exactly the same problem. Think about Australia, exactly the same problem. These countries risk losing control of their monetary systems because of stablecoins. So stablecoin could be big, and people are underestimating, I think, the potential here.
Very much so. Absolutely fascinating, because rather than, let's say, somebody saying, I want to buy just US dollars and put them under the bed at home or whatever, or trying to buy US treasuries, which of course is not that easy, and certainly even in Australia can't even, it's very hard to buy anything at the short end. So literally you can stash your money in there and you get an income on the back of that stable coin, or it's purely you just park and you know that the value is not going to be eroded?
Well, at the moment, the latter, but the Clarity Act is trying to make it clear where there is a division. Now, when the Genius Act, which basically launched stablecoin last year, was enacted, the bank lobbies were so fierce that one of the concessions that had to be made was that stablecoin do not pay interest.
Right.
So the stablecoin producers at the moment are clipping big coupons and making huge billions in profits, because basically
on the exchange rate.
No, on the fact they're getting the interest and the client isn't.
Yeah.
So that this is a huge windfall for these guys. Now, one of the things that can happen is that the exchanges, so Coinbase, for example, or whatever, Binance or whatever, who hold these, you can hold these stablecoins on, basically have arrangements with the stablecoin companies where they get a kickback in terms of their fees. So you can actually earn fees in theory on these exchanges now, because the exchanges are getting a kickback from the stablecoin producers or issuers and of that interest. So that's possible. The Clarity Act will make that clearer, and it will facilitate the payment of fees, and it may even allow interest for offshore accounts. But we've still got to see that.
Right.
Now, what I would say is, as a sort of corollary to all this, is watch this space around the time that Kevin Walsh is appointed to the Federal Reserve. Kevin Walsh and Bessent, Treasury Secretary, work together closely. They are both advocates of stablecoin, as far as one can see. Bessent in particular has been very vocal about the attractions of stablecoin. And it could well be that there is some deal done between the Fed and the Treasury to endorse or underscore the use of stablecoin for US government transactions.
Wow.
And that could really endorse and kick this ball off.
Right. And that would also to create better counterparty risk as well for people that are, holding these stable coins.
Oh yeah, no, I think the fact is that if the US government is endorsing them, there's got to be an implicit bailout here.
Yeah, absolutely fascinating. And just before maybe we move to summarize, I just wanted to clarify on the stablecoin. So if the Treasury is working very closely with the Fed on this one, to what extent is the stablecoins going to facilitate the issuance at the short end for the Treasury?
Well, it does. I mean,
Yeah.
that's the circle.
That's what I'm trying to get to, in just making it really clear. This helps them fund their deficit at the short end, whilst also giving them greater control, basically, over the financial system.
100%. And that's exactly what's going on. This is part of the thinking. That's why the Treasury is so much behind the stablecoin. Is because stablecoin need bills, and the Treasury wants to issue bills, and therefore this is another facet of this whole process. Now, one of the ways that we describe that, and this has been a sort of, if you like, a longer term theme, is to say that what we're shifting away from is we're shifting from Fed QE, quantitative easing by the Fed, to Treasury QE. In other words, the Treasury is basically imparting the big liquidity stimulus. Now, the difference between the two is that if the Fed basically injects liquidity, it kind of goes everywhere. Every asset gets soaked, and all asset prices rise. And that's been clearly a problem for the administration, because it's underscored a whopping great wealth divide in the US. And therefore, if you own assets, great. If you don't own assets, tough. You've lost out. And that is really unacceptable, particularly to Besant, as he says. And so now it's Main Street's turn. So what you're finding is that Treasury QE is directing money not into Wall Street, but into Main Street. And therefore, it's the real economy that should be benefiting from a lot of the spending. And that is likely to bolster things like defense companies, because they're always going to spend a lot of money there. Strategic stakes in tech companies, also critical minerals. All these things are really important looking forward.
Absolutely fascinating. At what point, if the cycle now came under some stress, what would be one of the catalysts for the Fed to suddenly have to change its course and start pumping more money into the system?
Without question, dislocation in the Treasury market.
Yeah, which is 2019 when the repo market was at it, or 2018?
Well, I mean, you could actually say as recently as 2025, because if you look at what happened in the repo markets at the back end of the year, there were some big spikes in repo rates, and that caused the Federal Reserve to come back in with alacrity and develop a new QE program called Reserve Management Program, Reserve Management Purchases rather, and that RMP has been quite significant. And if you look at Treasury holdings of the Fed, as a result of that RMP, they're basically going upwards. They've doglegged and started to rise dramatically. So there's been a very clear change in policy by the Fed, and that was caused by actually what was a relatively small decline in liquidity in money markets as a result of what the Fed was doing.
Just shows you the sensitivity of
the system. So there's absolutely no way they can shrink their balance sheet by trillions as they're talking about. I mean, it's pie in the sky.
Pie in the sky. Michael, this has been an amazing conversation. I'm sorry we didn't get to your slides, but I'll be brutally honest, I don't trust my technology skills enough. Hopefully we can chat again sooner than 1 year, because it's been 1 year with FNArena Talks. Michael is incredibly generous with his time to readers and viewers. And just if you outline what you provide on Capital Wars at Substack and also your book.
Okay, so we can run through what's around. Capital Wars Substack is probably the main vehicle, and we publish 3-4 times a week, including data and narrative. The book is called Capital Wars. I mean, that's now about 4 or 5 years old. Still probably pretty relevant in terms of the themes in markets, the big picture. And that's a Palgrave Macmillan book. And if you want an institutional service, we provide a lot of data, which is accessible through a website, obviously at a cost, which is called glindexes.com.
Fantastic. And you've actually recently had some of your data back checked against another US institution.
Oh, yes. That was I just mentioned that. Is that we do a lot of cycle work, and we were contacted by the Foundation for the Study of Cycles, which is a long-standing institution in the US who do a lot of, by the name, cyclical work. They've got very sophisticated algorithms to check cycles. They took our data away and actually confirmed exactly the timeline that we were looking at, which was basically a 65-month cycle for liquidity.
Fantastic. How long does your data go back? How many decades?
Well, our data basically begins in 1965.
Right.
Yeah.
I'd like to say that was a good year, but I think 63 was a better year.
Yeah.
Anyway, Michael, thank you so much. Lovely to chat. Lovely to see you in the flesh. And we'll look forward to hopefully having Michael with us another point in the future.
Great, Daniel. Thank you.
Pleasure.